Welcome, everyone, and thanks for joining us this evening. And thanks to Richard Hoefling, who will be sharing his wisdom with us. Please use the chat feature if you have any questions, and we'll pick those up as we go along. And so with that, Richard, if you'd like to begin, thanks so much for sharing with us with your expertise in estate planning.
Okay, thank you very much. And I hope everybody's been safe and doing well. And maybe we ought to go to the first slide, if that's possible. And basically, I wanted to talk about this area for a couple of reasons. One, obviously, there's a way here in planned giving to, help Belmont Abbey College, but even before that, I wanted to get over some basic concepts or thoughts that people might want to consider in relationship to their estate and just some general planning that you may want to do. So this will be, I'm not going to get into citing code sections or statutes or things like that, but just to go through also some practical experiences I've had in the estate area, and to also talk about the fact that I don't know what jurisdiction everybody's in, and you need to check your own state or check with a lawyer in your jurisdiction, but still the concepts will be the same. They may handle things just a little differently. And also when I get into some of the tax areas, depending on the size of the estate, I usually am working with the client's CPA as well, especially when you're setting up charitable remainder, or we have here charitable deed trust, because there's various requirements under the code. But an overview is on the gift and estate tax. It's a unified credit, and so what that means is that if you make gifts during your lifetime, and I will say this, I've practiced when the exemption was maybe $500,000, maybe $650,000, and now the exemption is $11.4 million. So people can pass almost $23 million to their heirs without any estate tax. But what it means by unified credit is that if you gave a gift in a particular year, that would go against that credit, so that when you passed away, if you over a number of years had given away, and each person gets to give $15,000 a year without a tax on it. So a couple could give $30,000, but let's say you gave more than that, then obviously you can take that off of the maximum amount you can do for estate purposes. So that's basically what the unified credit means. You can use it for a gift while you're alive, or at such time as you die. If you did, then obviously you have less of a credit available to you. I think that the other thing too, if you have questions or anything, I think, as Monica said, just go in the chat, and we don't necessarily want to just wait till the end. So if somebody has a question as we go through each slide, I'll be glad to try to answer it. And if I can't answer it specifically enough, I'll just get your information and get back to you on that. But the next thing is just the will and the probate process. Basically, probate is just the orderly distribution of personal property from one person to another. And I'll just give you an example. In North Carolina, by law or by an instrument, if you know who receives the asset, then it won't come under your will. It won't even go into probate. And sometimes that's good if you've got a lot of creditors. And I'll give you an example. If you have a life insurance policy that you're the owner of, if you have a beneficiary, well, you know where that goes. So that's not going to go through the will. If you own a house and it's owned joint with rights of survivorship, that will go to the spouse. The other thing to remember, the difference between probate and also the tax side of things, is that the government wants to know and includes whatever you have an interest in. So that's important, because they don't necessarily follow some of the state laws. They look at what you have an incidence of ownership in, and then they want to go ahead and bring that percentage share, whatever it may be, if it's 50%, if you're married, or whatever interest you may have in that asset, they want to include that. So they kind of gross it up, where some states, for probate purposes, you're not going to have the same estate. And some people will avoid probate. And I'll say that because some jurisdictions are similar to the federal government. They will tax and charge you a probate fee based on the total amount of your estate. Where in North Carolina, for example, they only include those assets that have not already passed by law or by statute. So the probate estate is very small. And so right now, most of my clients, I'm doing more of a distribution. We're doing trust because they have children and they don't necessarily want them to receive a lot of funds until they're older. But from if you lived in New York or Illinois or some other jurisdictions up north, they would go ahead, and if your estate was $1 million, they don't care. They just want to charge 3, 4, 5% times that, and that's why people try to avoid probate. And that's done basically through trust, because while they're alive, they set up these trusts for purposes of not, quote, owning it at death. So that kind of leans into the idea of trust. And basically, there are a couple kinds of trust. Obviously, the living trust you make while you're alive, and they're revocable and irrevocable. Generally, for tax purposes, you would use the irrevocable trust, because if you transferred assets into that trust, you don't have an interest in it. The trustee is the one that would be managing that under the trust document, and must follow that. And it's difficult in some jurisdictions to modify it. You can modify who the trustee is, because that's an administrative provision. But other times when I've tried to do it, you have to get all the beneficiaries, and that could be a problem based on your family and who the beneficiaries are. The revocable trust is again made while you're alive, and it gives you some control over it. And when you die, it becomes irrevocable. So that's a way to avoid probate if you don't have any really tax issues. I've had a number of clients who use the irrevocable trust for life insurance, and because they may have a large death benefit and they don't want to include that in their estate, so they put the policy in an irrevocable life insurance trust. And how does the trust pay the premium? Well, then they give money to the trust, which is going to be, I wouldn't do it exactly to the amount of the premium, but they go ahead and contribute some funds to it. And then the trustee uses those funds that were contributed under the gift levels, and they use that for the premium. And that's outside of somebody's estate, but it's still, the dispositive provision still gets the money to your family or to your spouse or whatever the purpose was. So that's something that is used. And so the irrevocable trust is generally to avoid taxes and probate, and it's a good instrument. And again, you have to look at what your personal intent is and what your objectives are, and everybody's not the same. Some people don't want to pay Uncle Sam any more money, and so that's one kind of client. And others, some don't care, because maybe they'll go out and buy insurance to pay the tax amount, because that they have the cash to pay for that, and then the insurance is there to pay the tax that may be due the state or the federal government. But everybody comes at it differently. I've had people come and say, yeah, they moved here from some other jurisdiction, or their neighbor says, I want what my neighbor has. They have a trust. And so you have to ask them, why do they want one, and what's the purpose? The testamentary trust is one that is in the will. So it springs into existence at death. And that way, that's used, for example, if you have children, there are sprinkle provisions, or there's a children's trust that If you have young children, you might not want them to get assets if you unexpectedly passed away at 18 or whatever the age may be. So you can spread those assets out to them in different percentages and at different ages. The next two types of trusts are ones that, and this also will relate very specifically to Belmont Abbey. And for example, there is a gentleman that has, I'll say, millions of dollars, and he needs to live off of it, but he doesn't have a spouse or children to leave it to. So what he did is, the money goes to Belmont Abbey College, and he lives off the income of the trust, and at such time as he dies, it stays with the college. I'm going to be at a pretty high level here because there are certain tests and certain distributions of income and so on. But if you're inclined to do something like that, that's when I usually sit down with the CPA and we work through the various percentages of what has to get paid and when does it have to get paid, and do the tests that are required by the code. Basically, the charitable lead trust is the opposite, where the income off the asset that's contributed or in the trust goes to, I'll use Belmont Abbey College as an example. And then when the person dies, the grantor, what'll happen is the principal, whatever's left in there, ultimately goes to his family. So they have those funds at that time. I've noticed there's two chats in here. So let me just go to that and see if we can do this. Okay. Okay. Rolando is letting me know to let you know this is being recorded, and maybe I ought to move on to the next slide, which gets into a little more detail. So let me do that. An overview of current gift and estate taxes. As I mentioned earlier, you can give away $15,000 a year without any tax, and if you're married, that's going to make it $30,000. What constitutes a gift? Well, a gift is something that has been accepted by a party, and that they have to have an interest in it. And I'll give you a perfect example. There was a case where. And this comes about in the irrevocable life insurance trust, where when the premiums are having to be paid and the gift of the $15,000 is given to the life insurance trust, the beneficiaries have the right to withdraw, and they don't, because they know that they're going to get the death benefit in the trust versus just getting a piece of the $15,000 that was been contributed. So that's what constitutes a gift in that context, because they have the right to withdraw, but they do not exercise that right. So therefore, the gift of the premium to the trust is a valid gift. Generally, selling something for value is not a gift, and so. If you get some value back for whatever you might have transferred, that would not be constituted a gift. You have to give up ownership to it, and somebody else has to accept it and take it on. The question here, what falls under estate taxes? Well, now you're at the federal level. And if you have an instance of ownership in anything, that's going to be brought into your taxable estate. There are deductions that you can take. But again, in today's world, the exemption is so high that there's really only 2 or 3% of the whole population that is worrying about estate taxes. As I said, you can pass, if you do it correctly, almost $23 million with no estate tax. The other thing to keep in mind too is there is a marital deduction, and it's a 100% marital deduction if you leave your assets to your spouse. However, if you do that, I would suggest also, depending on the value of your estate, you may want to file a tax return at that time to freeze some values or to make sure that you preserve a credit that might be out there so that you can pass the maximum that's allowed. I will say that there's a sunset provision, which means that in 2025, when the law was passed, they said it would go, if it's not modified, changed, or adopted to go farther, it's going to revert back to what it was, the exemption. So that's going to bring it back to about 11 million, 10 to 11 million. So you can see that's going to cut it in half. But there are lawyers on both sides that say that they've never seen a sunset provision go all the way back. There's usually somewhere in between that they end up, but nobody knows what that's going to happen with this election. It's going to be critical to see who wins, and that whole area could be changed completely. There are deductions, there funeral homes and debt. I mean, funeral bills and then debt you may have. And filing a tax return, and I will say this, that the rates if you have to file one, the rates get to 40% relatively quickly. But if there's no tax that's due, like I said, there are reasons to file a tax return only because you may want to set the value of a particular asset as of the date of death. And again, I just work with the client CPA at that time to determine what's the best approach. So it just depends on the size of your estate as to whether a tax return is due or not. So if we could go to the next slide, unless we've got any questions at somebody. Okay. I did go through the will and the probate process. I will say that a will is important, and I'll say because some people that pass away without a will, that's called an estate that would be intestate. There's no will, and so you'd have an administrator, so you don't know who the executor is. And also, what happens is the states have what they call an intestate succession statute, and they tell you where those assets go. And so they may go to someone, or a percentage may be different than how you would like your assets to go. I think if you own everything joint with rights of survivorship, you may not need one because you know where it goes. And when first one dies, the survivor gets it, meaning you own your checking account joint with rights of survivorship. You own or you have a beneficiary of your 401k or your IRA. But I do think if you have children, it would be good because you need a guardian. And I might want to just at this point talk about the players that are involved and what type of person you may want to have. Generally, there's an executor if you have a will. Their duties are relatively short depending on how complicated the will is, or if there's a dispute between family members. There could be a trustee, and I think they can be the same if you'd like. The executor's duties are basically to accumulate the assets, figure out what the bills are, and then distribute the asset to the various beneficiaries pursuant to the will. A trustee's duty may be long because there could be children, and there could be the sprinkle provisions where, let's say, the children don't get all of or they don't get their 100% until they're 30 or 35. So therefore, that trustee is going to be around for a while. There has to be some business acumen. They have to have some common sense, and they have to be willing to say no sometimes. So when I talk to clients, I hear that, well, I want my oldest son or my oldest daughter to do this and my other son to do that. And they may not be the right person for the duty or duties. And I recommend that you don't have of anything because they have to agree. And even if and again, these are not my documents, they're my clients. So if they want to do it that way, I have to put language in there that allows each one to bind the estate or to take action without the consent of the other, which in of itself could cause a problem if one person goes off and does something and the other one didn't know about it and didn't agree to it. Then they have a dispute. But that's going to be between each family. It's going to be between the dynamics of a family. And sometimes I've had to put in there if they wanted to just have one final decision maker, is at least in consultation with. So those are some issues that I face. And also with a guardianship, if you have minor children, I generally don't recommend a husband and a wife. I've had cases where they get divorced and then the wife argues she's the better one to raise minor children, and the husband. And so you're just setting people up to have some issues. So I always think it's good to have one person, but also make sure you have an alternate. So in case something happens. I did go through what probate means, so there's no need to go there. And unless there's any questions, I don't see any chat. We can go to the next slide. I went through these trusts. I didn't, get into various codes and the various percentages. I know you have to make distributions on a regular schedule. The interest rates have to be above a certain amount because Uncle Sam wants to get at least their income tax off of what is ultimately being distributed. I think that most people that I have want to avoid probate, so I usually do a will, and then I would do a living trust, which would be the revocable kind, so that they have flexibility in their life and that nothing is etched in concrete. On the larger estates, then yes, because they can put some assets in an irrevocable trust because they don't need them to live off of, and they get it out of their estate and they get into a giving program. If you have 4 or 5 children and you start to give away, $30,000 a year, you've taken assets out of your estate and moved it into the trust for your kids' benefit. So I do think if anybody is interested at some time in their life to leave some assets to Belmont Abbey, the development office, and I've been involved in a number of these over the years, and it's really working together with the grantor and his needs, his family's needs. And I know from the college's perspective, sometimes they're restricted and sometimes they're not. But those are two good types of trusts that can benefit an estate, as well as from taxes, as well as help the school. So may want to go to the next slide. Okay, a couple things here. Leaving funds or assets to an entity. Let me make a couple comments relating to the college. Over the years, there have been a number of people who have left parcels or tracts of land to the college. And one of the things that the school has come up with is the fact that before they have a policy, and it makes sense because you might get an asset, let's just say real estate, and it has to be reviewed or looked at and checked out before it's accepted, because what happens is when you get the land, if the college gets it, then there could be some environmental issues. It may not be accessible to to a road, and then therefore you're landlocked, and so it doesn't have as much value as the party is saying. And the other thing too that the college requires is that there needs to be an appraisal that is done, so that that's kind of the issue there. So just keep those kind of things in mind when you're dealing with land. I've got another question that came in which says, when are inherited assets taxable at the federal level, and when are other assets not taxed because of step up provisions. The answer to that is the value of the property that you own is valued as of the date of death. And if you've received something during your life as a gift, you get the basis of the donor. And so you can increase that if it's land because you've improved it, then obviously your basis goes up. But to answer it more specifically, when I have a client that is in their later years of life and they want to go ahead and just give their house to some of their children, what happens is then there could be a tax because there is a gain on your residence. You get a $250,000 credit, so as long as your gain isn't greater than your basis plus 500,000, you don't pay a tax. But when a person dies, you get a step up in basis. So whatever the value of that real estate is as of the date of death, and then therefore there would be no tax at death. So sometimes what happens is, they hang on to it, and when they die, then it goes to the heirs, and they sell it, and there's really no gain because of the fact that you get a step up in basis as of the date of death. So it just depends again on each parcel, each person, what's their objective and purpose. My job is not to tell people what to do, but my job is to help them get to where they want to be. It's their documents, and in every case, there's pluses and minuses for each. And so, you just have to talk about what are the pluses and what are the minuses, and each person looks at their own estate, and then they'll make a good decision for themselves. And as long as they haven't put anything that's irrevocable or outside their reach, it's not etched in concrete, and you can change as the tax law changes or as your life changes. And I've got another question here. Who is responsible for obtaining the appraisal for real property, art, etc.? Well, generally the donor does that because of the fact that they may need to file like a gift tax return, and you want to have an appraisal attached to that, especially if it's like a grand piano or some art that is pretty valuable, and it's their duty and responsibility to get that appraisal. And then when you file a gift tax return, you attach it, and hopefully everything goes well. Let's see. Stock is you can leave any asset you wish through a will if you'd like. And stock is also, a lot of people will transfer the stock to an entity, and in North Carolina they have a provision that's called paid at death or transferred at death. And I've noticed in some LLCs, the membership interest is personal property. So what some clients will do is they will, on the back of the certificate, transfer at death to Belmont Abbey College, for example. And then what happens is the college has the LLC, the other members of the LLC. Obviously, there's also a buy-sell agreement and operating agreement, so that then that gets turned into cash, and the college gets the cash, and the other members travel and take the company and continue to run it. But named beneficiary of a life insurance policy, I think it's important for people to analyze when they get ready to do any estate document to make sure all your beneficiaries are up to date and what you think they should be. You can obviously you don't have to leave 100% of the death benefit. You can get a change of beneficiary form, and you can have a percentage left to, for example, Belmont Abbey, or you can have, if you got a number of kids, you can divide up the percentages. And when you die, you just get a death certificate and you get a claim for it, and you send it on and it'll get paid. Retirement or IRA accounts, I know you can do self-directed IRAs. And you can have beneficiaries. There are some issues now about IRAs where people are trying to stretch the IRA where they leave it to a trust, because under the Secure Act, they give you 10 years, so therefore you're paying taxes on the distribution. And some people that have a lot of funds in an IRA are looking into those type of procedures to save taxes down the road and to stretch the term out on the receiving of the funds. But it also depends on what vehicle. I don't. Trying to think of the different type of retirement accounts. Sometimes the you might have a company that has a non-qualified deferred comp plan or something like that, where they only pay it out to the employee and the spouse, and so that's an all or nothing. And obviously, some investment accounts you have the right to do it as a percentage, and if not, maybe in your jurisdiction you could do a transfer to death or pay to death, which you can do with a lot of bank accounts. And that's another area that I see some issues. People think that they because they're signers on the account that they're owners, and in reality they're not an owner, they're just a signator, and they can sign checks. So when the person dies, they find out that they're not the owner, so now that account's frozen. So I advise people to check with their bank, make sure if you want, a daughter or somebody else to own that account, then it would pass to that particular person at death. And again, you may not, but if it's owned individually, then it would be in the deceased estate, unless you want to put on their transfer at death to, and you can name whomever you'd like. So I got a couple more questions here. What about donating underwater stocks to charity? Good idea or not? I think, let me see what else. Hold on one second. Let me see if I'm missing somebody. Chris, if Belmont Abbey College is the beneficiary of an IRA, is the money taxable to the college when it is received? General rule is the IRA, if it's transferred to your spouse, then they can get it and roll it over. And then so there isn't necessarily, I know in annuities, there's going to be a tax on the annuity, and you can stretch that out over 5 years. An individual retirement account could be taxable when it is received. And so you have to be careful with those. And but I do know annuities. Uncle Sam always tries ways to get their money, even though it may be later, but they're going to try to get it if they can. Underwater stocks, I guess underwater means that the person may have, well, I don't know, maybe the person paid $10 for it, now it's worth $5, and they give it away. I mean, again, if you're the donee, you basically get the donor's basis, whatever it is at the time of the gift. And if the person wants to take the loss on his tax return, he may want to do that. And if it's going to appreciate in value, then the college would get the appreciation if it ever wanted to sell it. So I'm assuming underwater means it's less than what the donor paid for it. And those kind of things, again, we just have to get the information at the time the stock was purchased, at the time the stock is given, and what's the value, and look at the tax consequences on both sides of the ledger. Let's see, another one. Is the step cost basis at risk if a so-called blue wave election? If so, should gifts of appreciated securities take place in advance of the new administration? I would say hopefully we'll know what happens. I don't think we will on election night. I think that if I'll just say it, if Biden wins, and if you've read what their tax proposals are, I believe that the capital gains rate will go from 15 to 40. And so therefore, I think that what will happen is people will start in middle of November to before January 22nd, before he becomes the president, and analyze whether they should hang on to certain assets or do they sell them now and pay the tax at a lower rate. And again, the same analysis would be given if you want to give away appreciated securities where your value now is pretty high because the market has gone back up to where it was pretty much anyway before the pandemic. And I think that if you feel that the Democrats are going to win, I think you would obviously want to make sure you don't suffer losses in a major way if the market ultimately drops after the election. So again, it's a timing issue, and I think as it relates to stocks and those types of investments, I take a long view. I think it's difficult to time the market. I think you have to have a good advisor, and you have to look at what are your preferences. What's really important to you? Are you going to be checking it every day, and that bothers you if it's down and you can't handle it? Well, then maybe you shouldn't be there. But if it's a long-term investment, then just take the ups and downs. And when it goes down, you just buy more, and when it goes up, you can sell it then, or you just hang on to it. And sometimes it's timing. And I think it's difficult to time the market. I'm not an investment advisor. If people ask me what my opinion is, I will tell them, but I always refer them to whoever's been handling their money. And hopefully it's somebody they have a good relationship with. And over years, they've done well for them. So to say, yes, you should give the appreciated securities away. I don't know the total estate of the person, and it may be good if they don't need that asset and they have plenty of other assets. At least that would be helpful. Hopefully that kind of, I don't know if it answers your question, but it gives you some ideas as to what should be considered in making that decision. Want to move to the next slide? Plan to giving to Belmont Abbey College. What does this mean? How and why? I think that there are a number of ways, obviously. And also it goes through cash gifts, pledges, restricted, unrestricted, pros and cons. I will say from the college's perspective, I have been on the board for a number of years, not as a voting member, but as secretary for the board. And I've always tried to recommend that they get into a deferred giving program where people either in their wills or some other mechanism where and unfortunately they haven't done that, but they're starting to do that now. So I think that helps with the school where they can get funds when somebody passes away. Maybe it's life insurance or some other mechanism that we've talked about today. I think the school, it's a private school. Its endowment isn't one of the largest. It's not the smallest. I think the school is doing very well. Admissions has been great this last year, and they're ahead for next year. So if that continues, we'll probably have to build some new dorms again, which the new ones are coming online. I don't know if everybody listens to Bill Theofelder's video, but he has kept everybody up to speed. I think with the new nursing programs, I think that's going to be a tremendous asset to the school. The fact that the hospital is going to be on the monastery land, which will generate revenue for the monastery, and their major apostolate is to help the school. But everybody has to look at this from a perspective of their relationship with Belmont Abbey College and to try to help it, be the best Catholic college that it can be. And there are numerous ways to do that. And if you have any questions, obviously the development office would talk to you, or you can call me, and I'd be glad to assist in any way. There are a number of people that make pledges over a number of years, and the restricted and unrestricted. Let me just say, I know from the college's perspective, unrestricted is generally better than restricted, but that doesn't mean that they're not happy on both. For example, the gentleman who I used earlier, in his trust, the funds are going to be at the school, and he wanted those to be in 4 different areas. He wanted it for scholarship for, let's say, a science student, or a scholarship for somebody in business, and another piece went towards deferred maintenance. So what that does is, even though it's restricted, it still helps the school. It's funds in addition to what they don't have, so that internally from operations, they are able to, cover expenses that need to be covered. And when it's unrestricted, then, the school will use those funds each year, analyze what they have and the earnings off of those funds to meet their normal operating budget, and spend them in a way that will help the school continue to grow. So it's up to the grantor or donor of the funds as to what they would like to do. And really, any funds that the Abbey gets, whether they're restricted or unrestricted, I think is a positive, because somebody has felt that it's important to help the school, and that's just an overriding benefit. And I do know, for example, a number of athletes that I know have given to, let's say, the soccer team, because that allows them to get scholarships, and that helps the team, and it also helps then, just the whole overall benefit of going to Belmont Abbey College. So, want to go to the next slide. Q&A. Any other questions? Hopefully I've helped people, or at least gave you some ideas to think about helping Belmont Abbey College, as well as your own estate, and those things that you need to consider when you're preparing a will, a trust, a power of attorney, a healthcare power of attorney, so that your estate will be in order, and it's going to benefit the people or the institutions or charities that you want to get benefited. And right now, it's like I said, it's not a transfer of assets just to avoid taxes now. And so hopefully it doesn't go back to where it was, because well, in some respects, some lawyers hope it does, because then there's more planning versus just distribution. But at the end of the day, from my perspective, these are funds that you earned, and you've probably paid tax on some of it, so there's after-tax dollars. And if you've been a good investor or you've grown, then why should you have to pay tax on it again? That's a personal opinion, but I just hope that I've been able to spend some time with you and share some practical experience, as well as some legal sides of what you need to consider. And I think that's really where we are. I thank you all for being here, and hopefully if you need any help, if I can help guide you in any way, even if you're not in North Carolina, if you're in another jurisdiction, just please give me a call, and I'll be glad to help you in any way I can.
Thanks so much, Richard. It's been very informative. It's been a pleasure listening to your wisdom. And I'm Monica, again, for the crowd. So if you have anything else that you'd like to cover with me, please do contact me. It's Monica Mattioli, Mattioli at bac.edu. And I can help you myself. I can connect you to Richard, and we can go from there. Thanks a million.
Thanks, everybody. Have a nice evening.